Yeah, the tariffs continue to be an issue all of us are tackling. It's impacting roughly 12 to 15% of our overall business. But despite that, we've been able to have a very good quarter once again. We came off a strong quarter for a number of reasons, and we're pleased with our financial results. But yeah, every retailer is dealing with the issues of the tariffs.
Yeah, quarter was good. Revenue up 5, U.S. comps up almost 4. How much of that is at risk in the quarters to come if this lasts?
I don't anticipate it having a major risk on our future. In fact, I think it's pretty bright. Our quarter is driven by predominantly 3 things. We had a lot of new store growth. We opened 47 in the quarter. As you mentioned, we had solid same-store sales growth, and we had a nice surge in our digital business, which was up 55%. And I got to tell you, I give our local owners a ton of credit here in this regard. They're really leveraging this new brave digital world by using their physical assets, stores, inventory, vehicles, people, while we integrate that with our digital investments. And I think that's why, we continue to see north of 90% of our digital business is continuing to be pick up in store for free by the consumer, where they're leveraging their local store. And then just recently, we launched our BODFS initiative, a dumb industry name that means buy online, deliver from store, where we're leveraging roughly $2 billion sitting in our local stores within moments of most of the world's home and business.
Interesting. Now, on pricing at least, have you identified how much you may have to increase price and how many SKUs that might affect?
Yeah, right now as a direct importer, we're the vendor of record. It's about 4,000 SKUs. We stock about 100,000. So lists 1 through 3, again, are generally immaterial to our future. And like all retailers, we're trying to, have the supplier absorb those cost initiatives so we can insulate our customers from the price increases. But again, roughly 12 to 15% is at risk with lists 1 through 3 thus far.
So, John, can you just give us some examples? Is it tools that are made in China? And if so, can those products be made elsewhere?
Yeah, that's obviously something we're looking into as well. The direct import from China is getting hit heavily in tools, as you heard from the CEO of Black & Decker moments ago, and that obviously then impacts us as they're a supplier to us. We continue to look to move our supply chain elsewhere. We've done that in other areas of Asia, but as you know, that is not a quick fix. That is a longer-term solution, and given some of the uncertainty, it's hard to know how quickly to move, but it is a lever that we are pulling. But still, the vast majority is coming from China, which will be impacted by these tariffs.
Any sense as to how much the consumer can withstand in terms of higher prices? I don't know if you hear it from the ground in terms of your people who are running all these stores, but where that sort of sweet spot will be?
Yeah, again, there's no one who's fighting for their neighbors like the local Ace owner. I feel fortunate that our business is not massively impacted by these tariffs. Again, it's a little over double digits, as I mentioned. But these folks in the face of that are not focused on that. They're focused on trying to give value to their customers. And predominantly for us, it remains a laser-like focus on service. Our stores have an irrational pursuit of serving their neighbors. They live there too. Convenience, leveraging the local stores and the inventory locally in these markets so we can try to be faster than Amazon on stuff we stock. And then ultimately, they're focused on high-quality, differentiated goods. They're fighting after goods that are higher quality, more differentiated than perhaps you'd find at a discount website or a discount warehouse store. That's their focus: service, convenience, quality. And the tariffs do run into, the issue from time to time, but it is not a material impact on our business and therefore our customers at this point.
I wonder how you characterize the impact of weather. There was a lot of discussion this morning about the wet spring, especially in the ag economy. A lot of farmers have been unable to plant and might have to switch from corn to soybeans. If that's a big deal, or if it's more about, existing homes have had some trouble in terms of sales, if people are choosing to fix stuff rather than sell?
Weather remains a material driver of our business. In fact, we joke when sales are up, we take a lot of credit for great leadership, and when we're down, we blame the weather. And this first quarter worked out very well for us. As you know, we were up 3.9% in the first quarter, a lot of that driven by winter. Our stores are there when it hits the fan in terms of winter with, ice melt and snow shovels and snow blowers, things their neighbors are going to need. And then on the flip side, as we go into spring, if you look at our first quarter like some retailers do, which would be February, March, April, our stores are up 5.1% on a same-store sales basis, which would be, I think, top quartile of retailers in the country at this point. And again, a lot of that is their focus on service, convenience, and higher quality goods, but also the impact of favorable weather in April. I think we're going to see that flip a little bit in May because it's been cool and wet.
You know, I found it interesting, John, that you talked about how one of the big sources of growth in your business is digital, because Home Depot, Lowe's, trying to figure out the same thing, buy it online, pick it up in store. And I guess I would think that they would have more scale, they would have bigger stores, bigger sort of warehouses to fulfill these consumer needs. Is that tough to compete with some of those bigger players?
For sure. The names you mentioned, Sarah, are outstanding retailers doing a very good job in the digital space and, of course, the physical space. We feel like we've got a strategic differentiator, though, that's different than them in that we have a lot more stores. You know, we have 5,300 stores around the globe, and 4,500 of those are in the U.S. So you've got about 3/4 of American homes and business within 15 minutes of an Ace store. So while their volume is higher, our number of stores is nearly double, and that gives us an opportunity to exploit this geographic proximity advantage, including we don't farm out our home delivery, buy online, deliver from store. We don't farm that out to a cobbled-together strategy of third-party carriers. We do that with our local owners. It's their red-vested heroes that are doing those deliveries to their neighbors because they're living right in that community, and I think that gives us a speed advantage as well as, I think, a higher quality advantage.
What's the biggest thing you'll be looking for in the back half of the year regarding the consumer, John?
Yeah, we continue to see a pretty vibrant consumer. And, you know, Carl, I feel very fortunate. Forgive me for just answering it from an Ace lens, but we feel very fortunate in that our business is driven predominantly by home preservation. Paint, power, outdoor barbecue, you know, backyards and barbecue, and then home preservation is not as susceptible to be whipsawed by tariff news or, you know, consumer sentiment. Whereas home renovation, which is some of what our other competitors are focused on, tend to be a little more sensitive to a consumer that might be a little fearful about the future. Our business tends to be insulated from that.